Yeah, so I'll just start the presentation now, so I'll move on to slide 2. So it largely covers what I've done in my career to date. So the purpose of this talk is really to sort of hopefully give everybody a flavour of how modelling is increasing in prominence within retail modelling in the finance sector, and also to show some of the applications of it. As Zoe stated, if anybody has any questions during the course of the presentation, please feel free to interject. So I just thought it'd be worth giving a little bit about me with regards to sort of my career to date. I pretty much was in Cardiff University until 2003, where firstly I did a degree in maths and statistics. That then followed was by a PhD in statistics, which was experimental design. One of the things which I struggled with as a student was actually figuring out exactly what I wanted to do. So my career has taken a few different routes, which has ultimately resulted in me being where I am now. So the first job that I had was as a statistical consultant within the pharmaceuticals. Really enjoyed that. It was for a couple of years where I basically sort of supported some drug developments, which was providing a consult to AstraZeneca and Roche. After that, I pretty much took a big change in terms of where I wanted to go with my career and ended up going into the finance sector. I really didn't have a clue, to be honest, whether it would be something that I'd like. Largely I was an academic, largely the work I did as a consultant was as an academic. But what I found when I went into the finance sector, that it actually lent itself well to some of my skills. And I thought it'd be worth sharing that with you guys on the call today. So firstly I joined HBOS, which was Halifax Bank of Scotland. That was back in 2007. And I joined as a senior analyst, and then I progressed through the organisation, becoming first a risk manager, which gave me line management reports to senior analysts and analysts, and then a senior manager, which gave me a broader responsibility where, in effect, I was managing managers, and that happened as part of Lloyds Banking Group, which had taken over HBOS during the last couple of years that I was there, as I'm sure you're all aware. At the same time, I was actually an university lecturer in Cardiff University also, doing an introduction to computational statistics, which is essentially looking at using SAS, Enterprise Guide in particular, and how it can be used to interrogate data. And he was teaching second year students that, all the way up from basic statistics to multivariate, such as principal components and the like. Again, it was about the applications of statistics. And that's really what my passion has been, and that's the kind of things that I'll talk through now, where you actually get to apply some of your learnings from your degree and even your postgrad and actually put it into real life problems. I then moved more recently in the last couple of years to Nationwide Building Society. It was a bit of a career change, so I was moving from more of the big bank culture to a more, I guess, homely environment, which is working for a building society, where big differences between the banks and the building societies. The building society don't have shareholders. We just have members who are people who have products with us, and largely the profits get basically put back in, to provide better services to the customer. But a couple of jobs since I've been at Nationwide. One was a senior manager, and I think this gives you a good idea of the kind of diversity that you can do as a statistician or a mathematician. The jobs I've got there is model validation, so essentially that is an independent auditor of the modelling team. Credit cards risk, that's where I was more involved in the day-to-day decisions of deciding who you give a credit card to, who you reject, and who you give an extension of limits to, again, which all involve maths. And then you've got retail modelling and IRB modelling, which is something I'll go into a bit more detail in the presentation. Ultimately, that's led to me in the last couple of months becoming the head of retail modelling, which means that I'm heading up a team of about 18 people, where we're responsible for doing a lot of modelling across the society, which I'll take you through. So I'm hoping on the back of this conversation, the people dialing in get a good idea of how important maths and statistics are in the real world, and how in particular this has been basically applied within the finance sector. So if we move on to slide 3, this is just an overview slide to give you a view of what retail modelling is. There's also other areas of modelling within the society and in banks, which is non-retail modelling. However, I'll just concentrate on retail modelling because that's really my field of expertise. So within the finance sector, retail modelling is all about three different areas. You've got the decision modelling, and it pretty much is what it says in the tin. So it's where you're making a decision about the customer or the applicant. So if you look there, there's a variety of different areas at which models are needed. Application. So if you come in, you apply for a mortgage, current account, credit card, personal loans at Nationwide, you'll go through a model which will decide whether you are a good or a bad risk. On the basis of that, we'll decide whether to give you a product or not. So further to that, we've also got to calculate what the customer's affordability is. So for example, if you apply for a mortgage, if you went onto the Nationwide site and typed in various key factors, that would then be run through a model which has been developed by my team and will tell you the size of the mortgage you can have. So after you've booked the customer, if you've decided to, so in other words, they've applied, you've said, yes, we're happy to give you a product. It's all then about the ongoing management of that customer relationship, which is on what's called the back book or behavioural. And essentially that tends to be around whether in personal loans you'd be willing to give a customer an extension of the loan. In credit cards and current accounts it's an extension of the limit. So if you think about with your current bank providers or building society, if you wanted an increase, you'd either phone in or you'd apply online to get your credit limit extended. That's all done through modelling and mathematical work. Then we've got the collection side of things, which is if customers miss payments, you can use models there to target particular segments that you want to contact earlier. Pricing is about how you go about determining the APR for the customer, and then propensity is more around somebody's likelihood to do something. So for example, have you got a propensity to respond to a certain kind of product offer? So decision modelling is all about those key decisions across the life cycle of a customer. Stress testing is far broader, and that's looking really into the losses that we incur, and also understanding how the portfolios, which is the term that's used for the customer base for each of the products, responds under stress. So I'll talk about that a little bit later. And then IRB capital is again something which is really critical for the business, and that's about understanding what your capital requirements are. As you can imagine, a lot of profile has been gained in stress testing and capital decisions since the recession, where I think the recession highlighted that certain institutions didn't necessarily have the right metrics or models in place, and consequently weren't able to lead, basically manage through the stress that occurred at that point. So I thought it'd be worth giving a little bit of background on slide 4 about the evolving nature of modelling. So in Nationwide in particular, there's been a huge focus on developing a modelling capability. So a lot of financial institutions currently have quite sizable modelling teams to cover through the decision, stress testing and loss forecasting modelling. Nationwide in the last couple of years has been playing catch-up largely, which has been a consequence of basically growing size of the portfolio. So in other words, we've been more competitive within the market and the need to make sure that we've got the right decision tools in place. So, I'm here as the head of retail modelling. When I joined, and became the senior manager in retail modelling, we had 7 people. That's now gone to 18. But if you tracked a year back further, it was just 4. And, I think talking to people like yourselves, it's, a lot of these people who've come in are actually maths graduates or postgraduates or have a numerically based degree. So there's a lot of applications of statistics, in particular in the finance industry. And, the kind of things that we're doing with the extra people is we're able to enhance monitoring of existing models. So if you imagine, if you buy a car, I think it gets 90 odd checks by the RAC to make sure the car's working. Fairly similar principles with modelling. What we do is we check a series of diagnostics or statistically derived numbers to have a look and see how our portfolios are performing and if there's any issues. Similarly with the car, if the car's getting a bit old, you want to replace it. Exactly the same as models. What you don't want to do is have models in there for too long a period, or they become redundant because they don't capture emerging risk trends. And, further to that, there's additional modelling options that become available. So the more people that you have available, the more models that you can develop to make sure you're making the best decisions. So as I said, there's been a lot of growth here recently, and in a lot of other organisations, there are large teams there in a similar manner, making sure that they're making the best modelling decisions. So if we move on to slide 5, I thought it'd be worth to give everybody a feel of the kind of work that's done in my team and in retail modelling in the finance sector. I think this is a good example of where, models are used. So current accounts, I'd imagine everybody has a current account. It's basically how people manage their main banking relationships. Nationwide have got several products in this space which are highlighted there. You've got the Flex account, which is your standard current account. Your Flex Direct, which is a competitive package with high interest. Your Flex Plus, which is a packaged account with a fee. And your Flex One, which is on the horizon, which is aimed at younger customers. So the idea of outlining what those are isn't really to do a sales pitch. It's just to actually highlight to people on the call that even within a product, there's different product types. So as I'm sure people are aware that if you're modelling things, if you have different populations or different products, you would have to do different models. So this is same across several products where you have different kinds of products, and the modelling team's challenge is to make sure all are accommodated. So we've got a suite of different products, and the decisions that we've got to make are like I highlighted earlier. So you've got, on a current account in particular, if you imagine you could go into a branch or you could go over the internet, the first thing that happens is, are you accepted or are you declined? So this is where the decision's made. Congratulations, you have a current account, or I'm very sorry, you haven't got one for the following reasons. You've also got the limit setting. So if somebody is accepted for a credit account, current account, it doesn't necessarily mean that they get an overdraft limit. And the reason for that is down to risk, and the reason for that is again down to risk modelling. Because if you think of it, if you give somebody a current account with no limit, it means they've got very limited opportunity to incur losses, and in a similar way to generate revenue through the interest and the fees that they pay. If you do provide limit, there's obviously the additional risk that you can incur losses. The models are really important in determining this. The behavioural element is just an ongoing management of the limit up and down. So if, for example, you've got a £3,000 limit and it is deemed that you are extremely high risk and there may be some severe adverse information on your file, such as you've got a county court judgment or a bankruptcy, then it's quite possible you'd have your limit removed. However, if you were a very good performing member is a terminology that Nationwide uses for somebody with a customer relationship, then we would look to reward that relationship if you required a limit increase. So if you wanted an increase and asked for it, you'd get that. And similarly with authorisations. So if you're in B&Q, an authorisation gets blocked, that can be down to the credit risk strategy, which is where Nationwide may say, actually, we won't allow that transaction to occur because it takes you your overdraft limit and we're not comfortable with that. You've then got the collections element of it, which is where on a current account you've gone over your overdraft limit for a specific period of time, and Nationwide then have to determine which customers or members we go and contact first. Because there's some customers, it'll just be a one-off, it was an accident. What you don't want to do is cause unnecessary distress or inconvenience by phoning or, getting in touch with the customer, and you may do it a bit later. On the other hand, if you have got a customer who you think is under financial stress and, you need to get to, then that's where, again, modelling comes into it. So if we go into slide 6, what this does is it gives an outline of what is actually involved in a model build. So for those statisticians amongst you on the call, you'll be familiar with model development. It's typically standard that you need to find out, right, what exactly am I looking to model? What data have I got available? what's the most appropriate modelling type that we use, and it's those kind of considerations that we do within the finance sector. And, it just outlines on the slide the key things that we looked at. So you've got to get your development sample, your representative population. So I'll give you an example in the context of current accounts. Nationwide, as I outlined earlier, I've got several product propositions. Some of them have only been around for a couple of years. So if I was to build a model on that population, you would basically not be able to build anything longer than 2 years old because it would be a completely different product. So you've really got to be careful with your development sample to make sure that what you've got hold of in the past is going to be representative of what currently happens. We put exclusions in there. So observation exclusions could be where you've got duplicates and you didn't expect it, or there's some data in there which, for example, we wouldn't book anymore, so we take that out because it wouldn't reflect what's representative of now. And performance exclusions, I think the best example there is that if the account holder was deceased during the 2 years over which you were modelling and missed payments, obviously you wouldn't take that as being a risk indicator because it's because the person's deceased rather than they haven't been fulfilling their payments. The other thing which you look at is modelling good bad. So largely in the finance sector, the kind of modelling that's done is logistic regression, linear regression. I have seen survival analysis used elsewhere, and there are other things such as neural networks and support vector machines, which we don't currently use, but as we get more sophisticated, we may end up visiting. So you've got to define what do I mean by bad in terms of the outcome, which is, right, you've got a current account. How long do I need to look at your performance to determine if that's long enough to determine if you have demonstrated bad behaviour? And then you've also got to define specifically what bad is. So it could be on current accounts. I will look at a performance window of 2 years from when you bought, or rather took the current account, and I will look at whether you have missed 2 consecutive payments at any point. So you'll be 2 payments down over 24 months. That would be my bad definition. Within model developments as well, you want to use all data that's available to you. So pretty much as with every kind of modelling, the more data you can get and the more diverse, the better. So we have application data, which is the data that we pick up when the customer applies. So that will have your age, your marital status, your living status, etc. We have bureau data. The credit bureau is essentially, I think the easiest way to think of it is, it's like a summary of all financial institution product performance. So what that will tell me is how many payments have you missed across all institutions, which, as you can imagine, is invaluable because we'll know if internally a customer has missed payments, but we won't know if they have missed payments with one of our competitors. And all financial institutions have the capability to access this information because it's shared. Cross-holdings then is, has the customer got a mortgage, have they got a credit card, and it's just taking into consideration the wider relationship. So for example, if somebody's got a lot of savings with us and apply for a current account, we know that they are very likely to be low risk because they have a lot of money, in their savings account. The scorecard segmentations then is more around, do I build one model for everyone? So in other words, if I applied for a current account, I'd get assessed under one model, or do I actually apply segmentations? So the kind of thing which we could do for segmentations there is use, have you got cross-holdings versus you haven't got cross-holdings, and create 2 separate models. So the reason for doing that in that instance would be, it could be that the cross-holdings data is a really, really good separator of risk. However, obviously if you haven't got cross-holdings, you wouldn't have that information, so you'd have to lean on other characteristics, and it may be better to build a separate model so that you can put more weight on those other characteristics. So I'll just pop on to slide 7 now. So this gives you a good idea of what do you model. So back to the question, defining what we mean by bad. So on slide 7, the graph on the left shows the outcome period of a bar definition is decided by the emergence analysis. So what that means exactly is the month since opening, which is on the x-axis, tells us the number of months that the customer has been with Nationwide, over time. So that goes up to 2 years. The barred rate is telling us the percentage of the openings within the month on book which actually go barred. So you can see we've got 1 payment, 2, 3, 4. The reason why the 4, which is the red line, is lower than the blue, which is the 1 down, is you've got to have missed 4 payments compared to 1, so there's far less chance of it happening. That's what explains the tiering. The higher up the bad rate, the less severe the bar definition. So we have to make the decision as in what bar definition do we want? Do we want 1 missed payment, 2, 3 or 4? And also over what period of time? A good example of how we decide what is the severity of the bar definition is included on the right in the table. So what we look at is that if the customer has missed 1 payment, if we look at the next month, what is the chance that they are going to be worse, stay the same or better? So if I'm 1 payment down this month, or I'd say I'm a population of 1 downs, what this is telling us is that 10% go worse, so 10% go 2 payments down or worse, 15% remain 1 down, so in other words, they haven't gotten worse than they are, but they haven't improved, and then 75% get better. So from like a finance institution, what you don't want to do is to model something where the customer's going to cure, because ultimately you'll end up making a decision based on this model whether to accept or decline that person's business. Because 75% cure, it's a too soft definition of bad, because they'll end up curing themselves. But if you look at the 3 down, what we can see there is 85% of people who are 3 payments down in a month are going to be worse the next month. 5% stay the same, 10% get better. So it's a far clearer cut in terms of what you would define as a bad. So that just gives a simple flavour of the kind of analysis that's done in terms of deeming what you are actually going to model. If we move on to slide 8, what this does, it actually tells you a little bit about the modelling methodology. So it's quite an interesting translation that's applied in the industry, and I'll talk you through it now to sort of clarify exactly what credit scoring is, because that's essentially what I'm talking about at the moment. So the modelling methodology that is used conventionally in developing models, scorecard models in particular, is logistic regression. So logistic regression, for those of you who aren't familiar, is essentially where you have a good bad outcome and then you use your data available to determine what are the best separators of the good bad outcome. And it's stepwise regression for those of you who are familiar with logistic regression that we apply. So you apply to each account the log odds of an account becoming bad. However, as you can imagine, working in a business such as the finance sector, what you don't want to do is to bamboozle people with really complicated equations on decimal place numbers. So what we actually do is the scorecard is used to derive the probability of someone going bad. So obviously that's going to have a value of 0, which means no chance, 0% chance of going bad, to 1, which means 100% likely to go bad. And obviously 0.5, for example, is 50-50. So what we do is we translate the score or the modelled probability into a score. So as an example of how we do this, it's highlighted in the table on the bottom of the slide. So what this is essentially saying is if my logistic regression model tells me there's a bad rate of 50%, so that's 0.5, 0.5, that's good to bads of 1 to 1, because there's 1 good to 1 bad. What you do is you can translate the 0.5 into 200, or any number you want. For the sake of this example, we'll call it 200. And 200 essentially means there's a 50-50% chance of somebody being good or bad. You then translate the other probabilities into scores as well. by essentially generating a rule that every halving of risk results in a 20-point increase. So 200 is 50-50, 220 is 2 to 1 good to bad, which means a 33% bad rate, 240 is 4 to 1, which means a 20% bad rate, 260 means 8 to 1 and 11%. If you went the other way, so if I had a score of 180, that would make me a 1 good to 2 bad. So in other words, I'd have a 66% bad rate. And essentially, this is what credit scoring is. The only difference that this has to other credit scores you may have seen is that the centre score of 200 could be different and the points double odds could be different as well. It all depends on what the institution decides to use as its centre score and points double odds. So I'll give you a quick example again. So what you could do is convert your probabilities into a centre score of 500 and a point double odds of 50. So the way that table would look at the bottom on slide 8 would be 500 is 1 to 1, which is 50%, 550 is 2 to 1, which is 33%, and 600 is 4 to 1, which is 20%. So if, for example, you went to Experian and you asked to see a credit file, if you were to have access to the score, basically that's all they've done is exactly the same as here, but use slightly different numbers. And that's the difference between a credit score and a model score. The whole motivation for doing this is that it makes it more palatable to the business, but also to the underwriters who we have dealing with customer queries, because the underwriters find it a lot easier to understand a score of 240 than a 20% bad rate, because they're not necessarily all as mathematically geared as most, maths graduates, for example, would be. So that's how current accounts work in terms of the modelling and the credit score. And what I've got here is an indicative example of what a credit scorecard looks like. So basically, logistic regression models good or bad, whether that be, for example, 2 payments down in 24 months or 3 payments down, whichever is decided on, you derive a model. And what the model ultimately does is it gives you the most predictive characteristics, which then are used in the model to derive your probability. Your probability is then converted into a score, which makes it more palatable. So this is exactly how credit scoring works. So if at Nationwide, for example, this is our current account scorecard, essentially you could work out your scores here. So I'll use myself as a case in point. Marital status 35, because I'm married. Employed full-time 35. Employment period, I'd have 41 because I've been here about 3 years. Number of credit searches, I've had a mortgage recently, so maybe I'll have 1, so that's 30. And then my cross-product relationships, I have got 1, so I'd add on 35. Time with Nationwide in months is over 2 years, so I'd add on 55. And with savings, I don't have a savings relationship here, so I'd have 35. So each of those 7 different characteristics would be in my model. I'd then get a score for each one, and I'd add them up. And then at the end of that would be compared against what's called a cut-off, which essentially is a point at which I'm willing to accept business or reject. If it's higher than the cut-off, it means my risk is low enough, so I'm accepted. If it's lower than the cut-off, it means I'm high risk and I'm rejected. So in the context of this, the higher the score, as in slide 8, the lower the chances of you being bad, so the lower your bad rate. Similarly, if you look in the scorecards, the higher the scores typically means the lower the risk. Okay, so I'll just move on now to slide 10. Hopefully. Yeah. So slide 10 talks about this cut-off decision, so how the model is applied in the business. So the way this is done is, just to recap, we build a model, we get a probability between 0 and 1, and then we convert that into a score. The score then basically tells me theoretically what the chance is someone goes bad, and then we set a cut-off point of the score to say we will only accept a bad rate of a certain amount, therefore we'll set the cut-off there. So in the example on the left, you can see we've got the score on the axis, and we've also got the bad rate. You can see on this, we've set the cut-off for about 400, and that could be because the bad rate, you can see, is about 6%. So you typically have what you call a risk appetite, which could be, we will not book a risk above 6% on where the margin is. That's near the cut-off. However, as you can see on the right, there's a more sophisticated way than that. So even though you build your models on ones and zeros, your goods and bads, you can look at internal data to look at the profitability of a customer. So what this actually demonstrates is, okay, maybe on bad rate, I'd have the cut-off at 400, but if I went lower than that, you can see that above zero is profitable. So it could be, I could bring the cut-off down and still be profitable and book more business. But there's a series of other things which come into the consideration then as well, such as I said, risk appetite. It could be that, yes, you are making money off those customers, but if the risk is quite high, it's not something as an institution that Nationwide would want to do, therefore we'll have a higher cut-off. And that explains why when you look at information on Nationwide in terms of risk, we're very, we're very conservative, so we're not a risky business. But we do look at things such as probability to give a more informed view of decisions. So after you've built the model, it's not the job done. And again, that's another reason why we need so many people in modelling, because you've also got to monitor the performance. So, after you buy a new car and take it out of the garage, that's not the end of it. You've obviously, you could have service checks and the like, and it's similar to the models. We've got to make sure that it's doing exactly as it's planned and that it's not breaking down. The way we do that is looking at model stability. So we look at how data and characteristics are evolving compared to the development sample. So as an example, if I pop back to slide 9, I can see marital status is married and single. So I've got that split into two bins or two sub-characteristics. If that was 50-50 at the development sample and was now 10% married, 90% single, it may cause a concern for me in terms of how the model's going to perform, because the mix of people coming through that is different to what I built on. So we need to check on that, and it's that kind of work that we do. Early performance analysis is also done. So what that means is that if I've got an outcome window of 2 years that I'm modelling over, I don't want to wait 2 years to see if my new model is working, because that would mean if I put it into live as of today, I'd have to wait until November 2016 to see if it's actually working. If it's not working, I should be able to tell very early. And the way I can do that is I can look at performance at 6 months. So if the bad rate at 6 months is higher than what it was at the development, that would possibly tell me I need to do something about my model. And similar to that is we look at expected versus actual. So we track the model, we work out the logistic model value, the probability of being bad, and we compare that to what actually has happened, because you would expect both to track exactly the same. So if I move back to slide 8, the table on the bottom there is my expected bad rate at 200 is 50%. What I'll have after 2 years of outcome is my actual bad rate. If that was 70%, that means what I'm actually seeing is a lot worse than what I expected to see, which would probably mean that I'd have to think about making changes to the model to make it work, or possibly changing my cutoff to reflect the fact that the business is getting riskier. So on slide 12, what I've got there is an example of the kind of monitoring that we do. So on current accounts, this is actual real data, hence why I've made it so small in terms of the font, but this shows you characteristic stability. So in the top left, what we have there is a characteristic. The different colours represent how the characteristic appears in the scorecard, and what you're able to see from that is by looking at it to see if there's any trends. So if, for example, I see the red part getting a lot bigger, that means there's a lot more people in that part of the characteristic coming through, which may not be a problem, but it's certainly something you'd want to know. Similarly, we look at the bad rate by split in the characteristics. So it's age we're looking at here. So you can see the risk then of each part of the characteristic. We also look at actuals versus expected, as I explained earlier, just about are things performing in line with what we modelled. And finally, what we've got there is something called a delta score. And what the delta score tells you is the actual risk that we're seeing more or less than what we would have expected. Any deviations from what we expected requires further investigation. And the way we deem whether it needs further investigation is by using thresholds. So, we'd have a threshold on the delta score to say if it's above 30 or 40, for example, we'll look into it. If it's less than that, we won't. So there's a lot of subjective decisions which are made, and they're largely made at the management level or above, because you've got to make sure you get the right balance in terms of what you put in your resource, to analyse. Because if you start looking at things that aren't of any materiality, you could be missing out on bigger things in the horizon. So that basically was an example of decision modelling on current accounts at the front end. So hopefully it gives you a rough flavour of the kind of things that go on in the background of modelling if you were to apply for a current account at Nationwide and at any other financial institution. So the next part, or the next slide, is on propensity. The idea of propensity is it's used to identify reward. So what I've spoken about to date, I do work in a group risk team, is risk. So in other words, it's what are we going to lose? The other way that you can use models is to identify how are we going to derive revenue or get the right customer behaviours. So this is propensity models. So it's the likelihood for a customer to basically meet a certain kind of behaviour that we're looking for. So transact on their account. So, you could build a model to find out what's the chance that somebody's going to use their credit card, which is obviously desirable for us because obviously if they have a credit card, you want the customer to be using it. Revolve a balance in the next X months. So what that means is to be paying interest in the next few months, to take up a product. So for example, are they likely to respond to a balance transfer campaign? So you could do analysis on that. There's many different ways you can use modelling. I'm sure some of you on the call would have been privy to getting mails from financial institutions, probably too many, where it's like, do you want a balance transfer, do you want a new product, do you want a loans, etc. And what the propensity modelling enables you to do is to make that a bit more targeted. So I think some organisations will blanket mail people on the off chance that they'll take it up. With propensity models, it makes you be a bit more sophisticated in how you do it. Means you're not bothering the customers with products that they don't want, and it means that you're not wasting operational resource and money on letters which aren't needed. So these are typically invested in the marketing area, as I was saying earlier, to improve marketing campaigns. So the next bit of decision modelling which I'm going to talk about is pricing. So the idea of pricing is to make sure that you've got the right price point for the customer. So in other words, what that means, if I went out with a credit card and said, right, it's a 12% APR for everyone, what that would mean is that I would be penalising customers who are low risk and I'd be rewarding customers who are high risk. So in effect, somebody who's got good credit risk may be able to shop around and get a better price. Somebody who's got worse credit risk will go, I'll come to Nationwide because they've got a far cheaper rate than I could get anywhere else. So the reason why prices are different is that it reflects the fact that customers have different risk profiles, which is reflected within the modelling scores. So at Nationwide as well, in particular, we look at the member or customer relationship to determine the price because we want to be rewarding deep customer relationships. There's also regulations around how many people receive a headline rate after you've given the pricing. So if you are promoting, for example, a 4.2% loan rate, then you have to, by regulation, provide that to 51% of your customers. So monitoring is done on that as well. But the main thing with pricing is making sure that the customer has a product to meet their needs and that you are being as fair as possible with regards to how you price them. So I'll just go into stress testing now. And this is an area of modelling, in particular nationwide, where a lot of investment has gone in to grow the size of the team and to grow the capability. And that's been because of increasing regulatory focus to make sure that we're assessing stresses on the portfolios in the best way possible. So the role of stress testing is to provide loss forecasts for secured and unsecured portfolios. So what that means is you have to do it on every portfolio. A portfolio being your mortgage product, your current account, your credit card, your personal loans. And the idea is that what you can do is to say, right, on mortgages, I expect to see X million losses in the next 5 years. And what it does is it makes sure that you're not managing outside of your risk appetite. So you're not booking business which is going to end up hurting you down the road, and that you're able to take necessary actions if the forecasts aren't what you expect. So there's a couple of parts which are involved, with a lot of work in both actually. The base scenario is the best estimate for the business believe is going to happen in the future with the economy as it is. And this is essentially an institution's modelled way of going, this is how much loss they expect, based on things not being too different from what they are now or how they're projected from now. What the additional focus has come in with the loss forecasting is beyond the base scenario, which is to go into a stressed scenario. The idea of the stressed scenario is you actually look at the portfolios and you model how they would behave under different stresses. So the way that you do that is you look at what the key economic factors are that drive loss forecasting, which you can do via analysis and modelling techniques. And then you look to adjust those in light of, sometimes regulators will say you need to stress unemployment, for example, up to 10%, or it could be you need to stress base rates up to 8%. And what we do is we actually look to see how the portfolios perform under the scenarios. And this gives a really good heads up to us internally into how our portfolios will perform under shock. And also it provides peace of mind to the regulators, you know, if we get through the stress testing with good outcomes that we're doing, you know, the right thing in terms of the risk management. It could also flag up to the regulators if there were any issues in the portfolio, because the models are very heavily audited, both internally and externally. So the stress testing then, moving on to slide 16. As it says, the changing nature of the role, increase in regulatory scrutiny. So the annual stress tests are now becoming the norm, and multiple scenarios are being asked to be run for UK and EU regulators, which means that there's far more challenges, there's far more deadlines and far more resources to cover the broader remit. And similarly, with regards to the regulatory scrutiny, it's really important that senior management know what stress testing is doing. So again, one of the challenges you get within retail modelling, and modelling in particular in the finance sector, is there's a lot of smart work that's done. But I think one of the biggest art forms is translating that into a language that the business understands. And that's important, particularly in stress testing, so that the senior management understand why portfolios are behaving as they are and how susceptible they are to shock or changes in the future. And, you know, as the next part outlines, knowledge of emerging portfolios and risks. So it says there, how will buy-to-let portfolios perform in an environment where base rates increase? So buy-to-let portfolio is a portfolio where essentially you've got landlords, so they've got interest-only mortgages, they've got tenants in there, and the risk of that is more difficult to understand because the buy-to-let market has only been running at a pace for the last 3 to 4 years, so there's not much stuff from the past you're able to model, but also the market could change in the future, and it'd be difficult to understand how the market would react to that change. So, you know, if people stopped renting more, you know, the rental market wasn't as buoyant, that would result in significant losses in the buy-to-let portfolio because there's no income coming in to pay the mortgage. The final part of modelling I wanted to talk about was IRB, or capital modelling. So the idea of capital modelling is very, very high profile, and it's used to calculate the regulatory capital that Nationwide requires, and it's done similarly elsewhere. You know, everybody's got to figure out how much capital do I need to have aside to make sure that, you know, we're robust for changes in the economy. The way that this is done is very, very heavily modelling orientated. Just put it in the sheet there to give people a flavour. So we calculate what are called the expected losses. That's the level of credit losses that we see or reasonably would expect to see. This is done by working probability of default. So that's the probability of somebody being written off. The exposure of default, so that's how much of a balance they'll have if they do go to default. And then the loss given default, which is actually talking about how much of that loss is actually crystallised. So we can gain back some of the loss when an account defaults through collections and recoveries activities. So it doesn't necessarily mean that somebody's going to be losing, you're making a loss for the full sum that goes in, because you may manage to get some back. The expected loss is then multiplying those out. Capital requirement then uses quite a complicated equation, which I've put down there just for completeness, which I think is a bivariate normal, leveraging parameters which are derived, you know, as part of the modelling exercise. So that's how we go about calculating our capital. The key challenges are highlighted on slide 18. And again, there's the regulatory aspect. So there's a lot of scrutiny on the assumptions within the models from the regulators just to make sure that we've got the right level of capital aside. And this is also then consequently results to enhanced internal scrutiny. So there's been a lot of investment again in modelling to ensure that not only are we building models better and documenting them better, but also that we've got internal validation teams to provide an internal audit of the models before we submit them to the PRA, which is the regulatory authority. Further things on the horizons is IFRS 9, and essentially what that is a more complicated version of the IRB models, which is something that we'll have in plan very soon. But the retail modelling area, I hope you can see across the piece, is very broad, and what's happening, particularly as of recent, is that it's getting deeper with more work involved across each of the areas. So that's pretty much my presentation. Where I see modelling going, you think, in the next 5 to 10 years? I think it's a really good question. The interesting thing with modelling is that it has evolved over time within the sector, but I think that it hasn't necessarily evolved at the kind of pace that it has in academia. So I think that essentially what we'll end up seeing over the next 5 to 10 years is that there'll probably be more need for modelling with regards to satisfying regulatory needs, which in some senses may need the models to be simplified in effect. But I think also on the flip side, there'll be more need to do R&D, you know, do the research and development, understand what the best modelling approach is, and to invest time in that. So I think that's something from what I've seen within the pharmaceutical industry and the financial services is that the pharmaceutical industry will historically did spend more time in looking into the methodology. So I think in the finance sector we'll probably see some advancement in that space.
Are there any other questions from the audience before I finish the meeting off?
Hi Zoe, all right?
Oh, yeah.
Yeah, I've just seen the questions appear.
This is from Tim Farley. In addition to monitoring of actual versus expected performance, opportunity exists to update the model using new data as experience accumulates. Clearly this should not be done too frequently as there is value in having a good size series collected under identical conditions, but not updating and adapting the model does not make full use of the accumulating data. What factors are taken into account in balancing these two approaches?
That's a really good question, and it is right, because what you don't want to do is to build a model and, as I was saying, wait 2 years until it reaches maturity to see if it's performing in line with expectation. To Tim's point, in terms of like balancing approaches, if we end up getting some fantastic data which we know is very powerful in determining risk but wasn't available when we originally developed the model, we'll simply look to redevelop and look to incorporate it in there. Further things that we do as well is that we look at short-term performance, as I outlined earlier, And if it turns out that certain characteristics are becoming more predictive than what's in the model, that would then instigate further analysis to determine whether we should be putting them into the model. So it's a bit of a, it's a bit of a fine balancing act that you should always look at short-term performance and you should always look at improving your models.
Mm.
And I think there's another question as well, Zoe.
There is. They're firing in now. So yeah, this is from Ellen Rees. Self-employed people find problems getting acceptance. Do the modelling team lead in suggesting new approaches, or do you wait for management policy lead to investigate new factors in the model?
So again, a really good question. Self-employment, is a quite distinct group, and it's one during the recession in particular. We did see issues with regards to losses as other financial institutions. So it's a bit of a fine balance in that. What the modelling team does do is that within the development, it looks to see if employment type is one of the key drivers. If it is, that would be included within the scorecard. But further to that, as it outlines there in terms of management policy, what we do also look at is certain subpopulations in isolation. So if you look at the self-employed as an example, it could be that we set a cut-off at a certain point that we may well, for certain niche populations, self-employment, not saying that we do, but we do look at different subpopulations and we may have a slightly higher cut-off just to reflect the fact that the populations are quite different. But we do look into that, and in terms of new approaches, we do look at the best ways possible that we can assess the risk for these people. So what you don't want to do is to unnecessarily penalise people, but similarly you don't unnecessarily reward them. So we work very closely with the portfolio risk teams who derive the management policy to make sure we get them to the right place.
That's brilliant. And it's bang on 3 o'clock, and I think there's no more questions. I'll just talk for 30 seconds in case another one pops up, but I think we're done. That was really good. Thanks again, Matt. I think that's probably my 10th. Thank you.
No problem.
Yeah, really interesting. And just a reminder to all listeners that this is recorded on podcast. So if you want to listen again, then please go to the website and look it up. Okay, thanks all. We'll leave it there.
Okay, cheers. Bye.
Cheers. Bye.